You're looking at a company that just lost over a quarter of its value in a single day, and the reason it lost that value is almost unbelievable. Roblox changed its own algorithm to make its games less addictive, and then told investors, yeah, this is going to hurt our sales. And the market's response was brutal. The stock fell 26.9% in one session, its worst day in over a year, closing at $35.60. That's the headline. Before this earnings report, Roblox was having a terrible year. We're talking a stock that started this whole window at $130.70 in August 2025, and by the time July 31st, 2026 rolled around, it had already lost over 70% of its value. The market had punished it 3 separate times. In October, they reported strong growth but warned about bigger losses and higher spending, and the stock dropped 15.5%. In January, a major analyst cut their price target, citing child safety probes and competitive pressure from Google, and the stock dropped another 13.2%. Then in May, they cut their full-year bookings guidance and said new age verification measures were actually hurting how users communicated and bought things. That one cost them 18.3% in a day. So heading into this Q2 print, investors were desperate for a sign that the bleeding had stopped. There was even a small relief rally in late June after one research firm upgraded the stock and another noted a spike in concurrent users. The stock jumped 14% to $54.34. They said they had revamped their recommendation algorithm, the thing that decides which games you see when you open the app. The new algorithm was designed to prioritize games with better long-term retention. The catch? To do that, they had to deprioritize the games they called cash grabby. Those are the games designed to squeeze every possible cent out of you while you play, even if you get bored of them quickly. The executives basically said, hey, this new, better algorithm is hurting our bookings. And to make matters worse, Reuters reported that the company was guiding for something they hadn't seen in 4 years, a decline in quarterly bookings for Q3. Not a slowdown in growth, an actual decline. The market's reaction was immediate and violent. The stock cratered 26.9% in that single session to close at $35.60. That's not just a bad day, that's the bottom of the entire drawdown, a full 74.9% below its peak from September 2025. It completely erased the June rally and then some. First, you had the weak Q2 report itself. The quarter simply didn't live up to expectations. Second, there was a sharp wave of analyst downgrades that followed the report, which just added more fuel to the fire. But the third reason is the real meat of the story. It's the fact that management themselves stood up and said, our own product decision is hurting our money-making ability. That's a terrifying thing for an investor to hear. The causal chain goes like this. The algorithm change pushed users toward games that don't monetize as well, which directly weakened bookings, which led to that shocking Q3 guidance of the first quarterly decline in 4 years. So where does that leave Roblox? It's sitting at that $35.60 close, at the absolute bottom of a year-long crash. The immediate problem is the Q3 forecast. The company is telling you the pain from this algorithm change is going to continue for at least another quarter, and the bigger, unresolved question is whether this is just a temporary transition cost, a few bad quarters while they fix the platform, or if it's a permanent drag on their earnings. They're betting that a better user experience will lead to more loyal users who eventually spend more. But right now, the market isn't buying it.